Good Thursday morning, Market Chameleons. Everyone joining us for the first time. Thanks for checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man, Dimitri Pargamonik. How you doing, D? You're on mute, D, I think.
All right, sorry, didn't click off.
No worries.
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Awesome.
And let's share my screen. If you guys are joining us for the first time and you have questions, you could type those questions into the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show live, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get to Zoom, click on raise your hand. You don't have to turn on your video camera, but you can ask your question directly. If you have questions about data, analytics, tools, strategies, you want to come on the show, share things that you've been doing that have been working for you or not working. You're welcome to come on the show and discuss that. That will benefit the entire community. While we're waiting for any questions to queue up, what I'll do is take a look at the pre-market report, maybe navigate to some parts of the website that I get questions on. If a question comes in, well, you'll stop me and we'll take them. Sound good? Yep, I think you're on mute. So,
yep, all good.
Okay, this is the pre-market report. These are these are stocks that are trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 77 stocks made our percentage gainers list, 42 on a percentage decliners list. So from that perspective, right now, looks more like a little bit of a bullish bias at the open. I'm going to filter out this list to S&P 500 stocks. This will take out any small cap stocks, ETFs, leverage products, all those, just to focus on S&P 500 stocks to see how it looks from that perspective in the marketplace. To do that, I'm going to use these filters here. I'm going to use in ETF, drop that down. I could select any of these ETFs in the drop-down list. I'm going to pick SPY. That's the S&P 500 ETF. And here I see a mixed bag. 3 made our percentage gainers list, 3 on the decliners list. So basically pretty even. Only one stands out right now is OXY. That's Occidental Petroleum. And I believe Warren Buffett took a big stake in that. Is that correct? I think he might be like the biggest single shareholder now.
Yeah, he keeps adding to it too. You know,
so he really likes it. Let me just take a look. I'm going to just open it up really quickly just to see. It has, just like the other energy stocks, it has come down off its high pretty significantly. I'm seeing 52-week high 74, trading at $57 in the pre-market, $57.50.
Yeah, and I think a lot of that move is literally in the last week. Like if you sneeze, you miss the top. It was a real quick move off the top.
Yeah, and what's surprising about it, that particular wager to me is that the Fed itself, our government, our Congress, are fighting hard right now to bring down those prices in energy. Right, they're really doing whatever they could to tame inflation, especially coming from that energy sector. So it's almost like a wager that they won't succeed, I think, right? Because that's really what I think is a big focus right now of the Fed, Congress, administration. They want to bring those prices down. They're looking at any way possible to bring prices down in oil and energy. So we'll see, how that plays out, but I do believe like that's almost a contrarian bet. What do you think, Will?
By Buffett, you're saying this Occidental Petroleum or
Yeah.
the oils in general?
Yeah, I think even the Occidental oils and energy at this point. At this point, it's almost you're fighting the Fed on that one.
You're certainly fighting the government and what they want to do with carbon-based fuels, right? And that's why they were beaten down for so long.
They're being down for a long time. Yeah, they're coming back up. So we'll see. It's an interesting bet right there. Keep an eye on that. And
when you look at the fundamentals in that OXY, what do they look like?
So let's take a look at that. And I haven't gone to read what they're saying in the on their earnings on their earnings calls. That's something to consider. I know Warren Buffett looks at that. He reads them, pays attention to what they're saying about the future, about their business and so forth. But if you look at it right now, I'm just taking a simple calculation, right? We talked about this yesterday when we look at, potential fair value for the stock. We start out with a simple calculator. You can build it out more complex. We did it with Virtue Financial yesterday. It's just an example. But here we see, if we compare it to historical multiples, it is trading right now at a 13% discount. So if we look at, the historical 3-year PE, price to sales, price to book, if we take all those and give it a valuation, then relative to the S&P 500, so this is the PE of Oxy and SPY. So we see that it's traded at a 38% discount to the SPY. Now it's at a 58% discount. So if we took all those on average, and averaged all these out, we get 6409 for the implied value. Right now, 5577. So that's a 13% discount. There's another way to look at it is try to project the future earnings, revenue, earnings yield on the amount invested, and compare that to the S&P 500 to see how far away we are for fair value. So I'm going to come down here, and you see one thing I'm noticing. This is comparing operating margins, OXY, SPY. So their margins, profit margins, went way up, 36% compared to a 3-year average 8.3, 5-year average 12.6. A lot of it probably has to do with just higher oil prices, right? Their operating costs could be fixed. Oil prices go up, margins go up. Oil prices go down, that's going to probably go down. So right now they're making a pretty large spread between their sales and what it costs them to sell. You can see here, 3-year growth rate, 17%. Last year, 75% in revenue. Again, mostly due to higher prices, right? So if we let's just take the 3-year average operating, if oil prices come back in, if they go back to 3-year average growth, 17%, I'm going to recalculate that. So 6290. So still 11%. So that would be more fair. So that's assuming, again, that if S&P 500 continues on the same path it has in the last 3 years, the next 5 years, same average growth rate, same operating margins. If Occidental Petroleum grows at a 17% year-over-year revenue, and operating margins come back down to around 8%, where they were in the 3-year average, then we're around 6290. Of course, if you think operating margins are going to stay high because oil prices are going to stay high, and revenue is going to continue to grow, then maybe then it is an undervalued situation. But I do think that one of the things we're seeing is that the Fed is trying to, the government, they're looking at that closely. So you have that to deal with as well, right? If they're successful, I think these numbers all come down.
Yeah, if they slow down the economy, people aren't going to be driving as much. I mean, gas usually is a leading indicator for a slowing economy as well. Gas prices.
They want to slow down the economy. Now, I mean, I've heard, wealth tax, on their profits and, all kinds of things, but who knows, they're going to get, because what's happening is that this is kind of a business, in my opinion, that the better you do, the more it costs consumers, the angrier people get, the more, governments react, the more regulation comes down. So, it's not the same thing as a tech company. The better they do, usually that creates benefits for, right? The more iPhones you sell, the cheaper they get, or the more, Facebook expands their free services or whatever, no problem. It's a little bit tricky, because the better you do, the worse it is for consumers, essentially. So keep an eye on that. Look, 3.6 times book value, 2 times sales right now, low PE, but oil prices can be very volatile. But that's the bet. I think I'm going to take another look at Meta, because this one was starting to catch my eye. And this came down, the valuations came down a lot. I think we were talking about it before when it was really high. We were talking about, that things are slowing down. Their business model, of course, is also under kind of attack by regulation with privacy laws and so forth. But it's starting to come down. And I think actually, yeah.
You want to plug in your unplug and plug in your mic? It's sounding a little grainy.
I didn't even plug it in today. Thinking, let me take a look. Try to plug it in, see if it's better.
It's good right now. Whatever you did just made it better.
Just leave it. Okay. All right. This is
actually, it just went grainy. It just went grainy again. Sorry about that.
Okay. Better?
Yeah, that's better.
So the Meta one, I was starting to look at, which is interesting. So here, I'm just plugging it a little bit into my calculator here, and I'm seeing that here are operating margins, 31%. They have been falling, but they are in a high margin business historically, right? So their margins, it's a tech company, digital ads. I do think that if we hit a recession, they're going to be impacted just like Google and other, place in that space, in the digital ad space. We see 3-year growth rate 26%. So I'm going to take that down. I'm just going to take this down just to compare it. And let's say that in the long term, SPY keeps growing. Even if we hit a recession next 5 years, let's say on average, revenues grow at 7%. Right? Let's give them that. And let's say that operating margins in SPY are going to be close to 13%. Right? Historically 11%, but I'm going to let's just give that to SPY right now, S&P 500, that they'll manage to, in the next 5 years on average, grow at that pace and on average keep those margins. So I'm going to give Meta, I'm going to just take that down. Let's take that down to 25% operating margin. So I'm going to take that down a little bit. And we can see that would be below anything we've seen here. And I'm going to give them a 1% growth rate. So let's just say they're going to have problems growing their revenue. Let's say their revenue is going to stay pretty much flat and just inch up a little bit next 5 years. Maybe not next year, right? But If it's flat or dips a little bit, it'll go back up. But on average, let's say they grow 1% year over year for next 5 years, 25% margin. So let's compare. I'm going to recalculate it. And what this will do is calculate how much they will earn over the next 5 years, take those earnings and give us a total return based on the market cap, right? Total return based on that market cap of Facebook versus SPY. So I hit that calculator. So here we're right around, I would say, almost fair value, right? And that's giving, so that's a lot of cushion there, right? That's a lot of cushion you have. 1% growth rate, 25% operating margins. And I think they are in a high margin business. So it is starting to get interesting, to take a look at. And I did have a question. Well, why do we compare some of it to SPY as the benchmark, right? So we look at SPY, that's the benchmark for how are risk assets priced on average, right? So we take the S&P 500 and say, well, if this is the S&P, because I could always buy the S&P 500 SPY and hold on to that if I think that is going to outperform any individual stock, right? But if I think an individual stock is way undervalued and is a better risk reward than the S&P 500, that's when I would take some of my capital from a well-diversified portfolio and put it into a riskier, single stock. The other reason is if I think that this stock has potential to outperform, if it has a potential to outperform Meta S&P 500, I could always hedge it, right? So I could calculate my hedge ratio using a regression analysis, my beta, and so forth. And I could hedge off my position in Meta versus market risk in S&P 500. So the idea there is if everything goes up, SPY goes up, Meta eventually will climb by a bigger percentage. If everything goes down, SPY goes down, Meta goes down, but Meta at this point will not go down as much as the rest of the market. So then between my position in Meta and my hedge in the market, I should generate positive alpha. Okay, so that's the reason on your initial calculator, we kind of try to compare it. How's this price versus the rest of the market? So just to give you guys a look, here are the results. So here we see market cap S&P, market cap Meta. This is their trailing 12 months revenue in Meta. So if we start out in SPY, right, first year grows at 7%. That would be the revenue. What do we keep from that revenue? That's our operating, the margin, profit margin, 2 trillion. Next year, revenue goes up another 7%, profit. The following year, another 7%. This would be the profit. So if we added up the profits over 5 years, this is how much profit we get. The market cap today, if we bought all the stocks today, 34.7 trillion. So that would be a 33.6% return on the market cap, on what it would cost you to buy everything today. If we did the same thing with Meta, gave it only 1% revenue growth. So you could see revenue just grows 1% year over year. In each year, we took a 25% of that revenue would result in a profit. So this would be the profit year over year. In 5 years, 154.1 billion. Market cap today, 423 billion. So that's a 36.4% return. A little bit better than the SPY, but that's also assuming only 1% revenue growth, 25% operating margin, which that would be very low for Meta from a historical perspective. So that's why now it's kind of starting to see it came off a lot. I think it's down more than 50% off its high. Let's take a look. What is
It's
it?
interesting you are looking at Meta because Jim Cramer was interviewed Zuckerberg last night on in the Metaverse.
Yeah.
It was a, you know,
How was it? Yeah, I
it
know.
was,
I didn't see it.
it's interesting. You know, I bought those Oculus goggles for the kids for the holidays.
Yeah.
And have used them a couple times. They're just so awkward to wear. It's hard to imagine how that migrates to what works for everyone, which is the phone, right? It's hard to understand how that jump takes place. Now, I have a nephew who is very into video games, so I see for him how it takes place, but I don't know what percent of the population. You know, it's super cool, but just sitting on a couch wearing those glasses at this point isn't for me. But you know, that being said, that is not in the earnings. You know, that is a strictly a cost, R&D cost for them right now, right? But exactly. if you're saying, well, I get Meta for, you know, the Metaverse and maybe one of the bigger players in the Metaverse, you know, and right now the PE is 12, so there's a growth stock potentially embedding it into this. Maybe it's something worth looking at.
Yeah, exactly. That's why I started looking at it. And as I was looking at it, you know, and then I was reading like some articles on, I think it was on Bloomberg, maybe. I saw Michael Burry, I think, started taking a position in it as well. And he's a big bear, right? He's a
monster. I mean, he talks about how overvalued the market was. At least he was short Tesla, which he got hurt on, but he's still negative on it. So
yeah, but this one started another one I started looking, Goldman Sachs was starting to look interesting, so we could take a look at that. But I think Goldman Sachs also, you know, some of these stocks have gotten crushed. I was looking
they're being priced like, you know, and look, the market foreshadows a recession, right? The market's typically, I don't know, what do they say? 8 to 12, maybe 18 months in front of a recession. So, you know, if you believe,
I think in general, though, the SPY still is vulnerable if there's a recession, because I was looking at the, you know, let's just take a look from the fundamental perspective. And, you know, I would look at it as if we do hit a recession, I think we still didn't feel yet in our economy what the slowdown in the housing market, you know, a slowdown in the housing market, slowdown in retail, slowdown, whatever, you know, is going to be caused from these interest rates, mortgage rates. And so that hasn't been felt yet. We're not in that space yet. I think just now I heard JP Morgan's going to start laying off people in the mortgage, but we haven't fully felt that. And interest rates are going to go higher, but I'm just kind of paying attention here right now, just based on last year's earnings. We're looking at a 6% operating yield, you know, EBITDA 8.8%, getting a little bit interesting. You know, if these numbers, though, once they get up there, maybe near 10%, especially if you think like I do that interest rates are going to be around 3% or higher, you know, this to me seems like if we could get up to 10%, that would be interesting. You know, I think that would be already an undervalued situation in the whole market.
Well, how can you put that into the model 10% and see where it takes?
Not in that calculator right now, but
hey D, your mic just went underwater.
Okay.
All right, now you're good.
Yeah. Not right now. And it also depends on, you know, what you think earnings will be next year, right? If you think this is assuming the earnings are flat, right? So this is assuming that there's going to be no growth. It's just using the last 12 months. If you think that there will be 10% growth, you know, or 7% growth, it will change it. I'll tell you this, analysts right now I mean, if you follow the analysts, they're not even moving. They think they're projecting 10% growth in earnings. So, but usually they're always delayed with stuff. But
Well, you mentioned the
they're
housing market, right? The housing market, I think, is like almost 18% of the U.S. economy or the
yeah,
GDP.
finance. Yeah,
Yeah.
finance is like something like 20%. And I think that's where we're going to start seeing, maybe starting feeling the effects throughout the economy, right? When the housing market goes, you kind of start feeling the effects throughout the economy. And it touches a lot of different businesses, retail, people stop buying stuff for their houses, people tighten up their belts. So I think that is something we'll feel. And another thing is, I think the Fed is looking at the tight labor market, and that's making them nervous. So we might see layoffs. We might start seeing like, hey, the labor market is just too tight, right? It's just there are more jobs available than there are people to hire them. And right now we're not in a good situation because everybody's working, but productivity is not going up. So something in our economy, it's not efficient right now. Capital allocation is just not efficient as it should be.
Well, we're right up against the opening bell. We did have a question from Michael McCrae. Maybe you can get to that tomorrow. He says, EBITDA, is that the same as operating margin? So maybe that's something.
No. Yeah, EBITDA, we could talk about it tomorrow, but that's
cool.
Something different. Yep.
So tomorrow we'll look at that. D, great job. Chameleons, thanks for attending today's show. I did put Raj's show from last night in the chat. It was a very good show. Thanks, Mike and Rob, for watching and commenting so other chameleons know. But that link is in the chat. Great job, Dima.
Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, community.